Good morning, everybody. I hope I'm loud and clear. Yeah, so first of all, I hope everybody's safe, everybody's healthy. This time around, I think I'm not sitting outside, so I think the outside interferences in terms of crows and all that stuff will be absent. Second, in terms of a brief outlook on how the markets have behaved since we spoke last week, there's been a tremendous spurt in the markets, global indices, as well as our own markets. What probably happened and transpired in the week gone by, I think a lot of negative news that was expected to come through was getting gestated by the markets. So if you probably speak about the pandemic curve, the kind of cases that were getting reported in major cities, including New York, and the rest of the cases emanating in the United States, what was happening in the United Kingdom and Western Europe in general, with I think a lot of cases and the plateauing of the curve starting to get witnessed in economies like Spain and economies like Italy, which probably gives some element of hope that there might be some curve flattening around the corner. The second element, in terms of not seeing a substantial spurt in the number of cases reported domestically as well, and the support that the risk on had in terms of equity markets globally. I think that is something that also created a huge spurt in terms of the reversal of action that was probably getting seen. So FIs surprisingly have been net buyers over the last 2 to 3 trading sessions, what also probably means that a lot of buying that was happening over the last 2 to 3 weeks, as we mentioned earlier, and which was a very, very obvious scenario in terms of safe haven buying towards US treasuries, in terms of the dollar denominated or dollar backed assets. I think further rate cuts is something that get expected, but I think you're almost down to zero in terms of the Fed rate cuts. So I think there is an element in terms of rebalancing that is getting played out. What also aids in the bets is the huge package that the US government announced. So $2.3 trillion dollars getting announced for small businesses, the buyback that probably happens in terms of municipal securities, corporate bonds, and municipal bonds as well. I think a lot of small businesses which will feel the interim and the short-term impact of the market move for the US as well as other markets as well. I think a lot of push-through has already started happening. The announcements done in terms of tax rebates, concessions given by a lot of governments in terms of concessions in terms of electricity, rent waivers that have been announced by certain Southeast Asian economies, including Singapore. I've heard a few provinces in China have actually announced rent waivers as well for a couple of months to help the businesses tide over the short-term pain that they'll probably witness, as well as the working capital constraints that they'll probably see. So I think the economic and the financial deleveraging, what we've time and again spoken about, I think how that plays out will clearly get reflected by earnings. The markets are presuming a strong earnings cut in the quarter to come. So for this quarter, you will see some element of the earnings cut getting played out. I'll discuss in terms on how a lot of sectors will probably get the hit in terms of the earnings forecast, and how a lot of sectors will face the heat and how they will face the challenges in the next few quarters to come. But I think it's an obvious underwritten rule that the next quarter, I think a lot of these sectors are going to feel the heat. A few of the sectors, consumer facing, FMCG, consumer staples, consumer discretionary to a certain extent, pharma, might get less impacted from the earnings blow. But again, I think the recovery itself in terms of the earnings chart, whether it's a V-shaped, U-shaped, L-shaped, there is also square root recovery that I read somewhere, is something to be witnessed and observed, and numbers will do the talking. As we said last time as well, I think a solid follow-through day was witnessed, whether that was shorts getting covered into the market itself, exuberance thrown out with a risk on that happens temporarily in bear phases, that the worst is probably over, the expectations of earnings recovery taking place and the stimulus probably taking care of the financial and economic hit that economies, sectors, stocks, and individual countries in respect of their fiscal current balance, balances will take a hit is something to be seen. If you put everything in context, I think the markets probably have been on a huge upswing. Whether any announcements come through in terms of one more package that is probably getting discussed on the Indian economic front is something to be observed. But how much of a hit can we take in terms of the additional debt that gets added on is also needed to be seen. What the US has done in terms of the new package that has got announced, obviously the kind of debt ballooning that will happen on US balance sheets, on the Fed balance sheet itself, I think it's going to be pretty substantial for this year and the next. I think a consensus estimate count is somewhere between 3.5 to 4 trillion odd dollars, which is almost 16 to 18% of the GDP in terms of the announcements that they've done for this fiscal, and another 2 trillion odd, which is almost another 12% odd in terms of the GDP hit that they will take. What it recounts or counts as in terms of a calibrated approach in terms of the balance sheet synopsis is that it might be a 12-13% kind of a fiscal deficit hit. Unemployment numbers might show a huge spike in the interim. You've already seen 6.8 million in terms of the claims that have been put forward. How much of those numbers actually get increased over the next few weeks, I think is a matter of how the businesses will probably get adapted to as well. Secondly, I think in terms of earnings itself, as I mentioned, I think for this quarter, when you're probably talking the Jan to March quarter, there will be a hit in terms of the lockdown that we've probably seen in the Indian context for 9 to 10 odd days. But the larger element, as I said, will happen in Q1, where again, I think the 21 day or the expectation of 14 days plus more days being added up, actually getting hit up in terms of balance sheets will play out. So if the first quarter numbers are amiss, and as global economies will still take time because borders are still closed, what happens to the export trade? Internally, we are seeing and witnessing a lot of supply side pressures, constraints happening in terms of interstate movement. So essential goods have been given the leeway. I think the production capacities are not running optimally, which means the kind of volume-led operating leverage growth that one expects might still be missing, even for a few consumer-led companies. It overall takes a hit in terms of annualized numbers. So one also needs to be taken into context that the markets, with the fall that they've probably witnessed, has also accounted for a large element in terms of the earnings hit that the market will take. When you probably talk about the price earnings equation and a multiple in terms of how the earlier panics and crises have played out, we've obviously seen them gyrate between 12 to 13 odd times to the extreme end of 24 to 25 odd times. So we are somewhere in the middle at this point of time, around 14 and a half, because even if one accounts and assumes and estimates as higher double-digit earnings growth hit that the earnings will take, or a degrowth that they will take for this year. And if you take into account the Nifty EPS estimate that the consensus community or the research community had for the better part of FY21, that obviously is going to come down. Now it's a fair estimate of 9 to 10 odd % for this period at this point of time. If the lockdowns elongate and if there is a further hit in terms of demand and supply pressures both playing out, I think the earnings hit can then probably turn out to be in the middle double digits, which can also have a substantial say in terms of the earnings degrowth from a Nifty EPS perspective. So I think one needs to take that with a pinch of salt. So I think 14 and a half times you are quite close in terms of how we are placed historically. The market cap to GDP, if you probably talk about bond yields, I think they are also reflective in terms of how the markets are viewing at this point of time. What we did see, right, in terms of the market move, as I said, I think it was a sharp element in terms of shorts getting covered in the system, an element in terms of some buying happening from the FI side, which was getting reflected in terms of positive numbers. So DIs offloaded some positions or rebalanced some of their holdings in this market up move. Whether this sustains is a matter of time. As I mentioned earlier in last week's webinar, I think the next 2 to 3 weeks are extremely critical. We witnessed a solid follow-through day. With that in perspective, I think we did raise some elements in terms of a few sectors, as I said, where the earnings hit might not be that substantial. It might still be there in terms of the Q4 and the Q1 numbers. But I think a few of the pharma stocks, a few of the consumer discretionary stocks, FMCG and staples in particular, will still see some positive traction happening in spite of the lockdown pressures that we are witnessing. with this, I think I will take over to the presentation that we've got. I think the entire theme in today's webinar is going to be how the markets are placed. Very, very briefly at this point of time, I've already taken you through, and how individual sectors are expected to react in the next few weeks, taking into consideration the earnings perspective and how the overall annualized perspective for each sector looks forward as well. Yeah, so as you can see, I think these were a lot of events which took place in the last fiscal. You obviously had the US-China trade wars that the global markets had to contend with. Obviously, the NDA government led by Prime Minister Modi retained power back on the Indian context. You had a couple of very scary scenarios as far as the credit risk markets were concerned. So I think the Yes Bank fiasco which played out, the PMC Bank fiasco which played out, clearly rattled the markets in the second half. But the changing point for the last fiscal was the tax cuts, the corporate tax cuts that Nirmala Sitharaman announced on 23rd September. Till that point of time, I think the markets were probably in a limbo. But I think the markets got a leg up, and we got a solid follow-through day that day, where the market spurted up, and for obvious reasons, because I think the Nifty earnings were expected to show a huge bounce because of the tax cut itself, which had a direct impact and a very positive implied impact in terms of the bottom line. The second half, again, I think was going very, very smoothly even after that, till the better part of Jan. The budget was announced. Yes, there were mixed reactions and mixed emotions as far as the budget was concerned. But again, the markets carried on with their motion of moving higher. I think the liquidity support that the markets were receiving, and a lot of central bankers had actually sprung in action. I think this RBI, for instance, had a growth-oriented approach with rate cuts being initiated by the Reserve Bank. But I think the later part, I think start March, and the corona scares, which had already started coming through in terms of data points from January itself, were becoming very, very prominent from March itself. So I think the kind of knee-jerk reactions and the scary fall that we saw in the markets were something to be seen. There are still recessionary fears that are getting played out in spite of the stimuli packages getting announced. Because as I said, I think the impact in terms of the exact economic and financial deleveraged connotations in terms of sectors and economies will still play out. So I think a few private bankers in the US are still running recessionary estimates getting played out for the markets as a whole. So I think this is a collage that we've done in terms of what the markets threw up for the last financial year itself. There were over the weekend some positive news in terms of Saudi Arabia and Russia actually arriving at a deal, but the expectation largely was a 12 million barrel cut. It turned out to be a 10 million barrel cut. So I think a lot of traders were a little bit disappointed, but I think there is some expectations that oil prices might find support. So I think the three C's, Corona, crude, and credit risk averseness, which got played out with are right there at the bottom panel of this collage as well. I think they clearly rattled global markets, Indian markets as well. You've seen a solid follow through, as I said. So I think being a little bit selective in these markets becomes extremely essential. Going forward, again, I think whatever stocks we might discuss, it's just for data reference purposes in terms of understanding the context of the market, and in no way should be construed as investment advice. So I think I've already taken you through what the key events were in the market itself. I think this image is very similar in terms of how the entire market played out. I think what we tried to play out here is MS Dhoni's run out in the Cricket World Cup. I think, yes, India was struggling in that match in chasing New Zealand's total, but Dhoni with the lower order were getting India very, very close. There was a huge chance with Jadeja and Dhoni, the way they were playing, that they would take India back and in the contention for getting us into the final. Unfortunately, I think the throw that came in was unexpected, and that ran out Dhoni and ran out India's chances as well. So what happened in the latter part of FY20 was unexpected in terms of what the pandemic has done, what crude and credit risk averseness has done to the system. And I think that ran out the markets very, very badly at the end of FY20. So just a reference point in terms of how we look at things. So I think this is the context that we briefly spoke about. And this is the chart that I want to bring to your reference as well. So I think till the tax cuts were announced, which is right there in the middle end of the entire Nifty chart, and that was around the end of September, the markets were really trying to find its feet. So they were gyrating between 10,500 and the lower end of the spectrum. right up till 12,000, because once the Modi-led NDA government came back into power, there was a lot of exuberance that got reflected by the equity markets. But again, I think they were just nimbling around, and the nimbleness in market was getting seen in terms of how the index was getting placed. So it was really nothing over the last few months, specifically from May to September, just moving in tandem. But since the tax cut got announced, I think the markets got a new breath of fresh air. And again, I think the moment that the index saw, specifically, I think a lot of the sectors with the beta correlated to the economy, banks, financial institutions having a huge move, NBFCs, where I think a lot of focus was laid out, and also stocks which were getting to be positively impacted in terms of lower tax cuts and an obvious reaction in terms of earnings improving just by itself because of tax cuts getting played out in terms of bottom line growth. So I think we were moving in fine fashion till the beginning of Jan, till the end of Jan. The budget was announced. Yes, there was some upheavals in the market at that point of time, but we were moving very, very slowly and softly in terms of how global markets were reacting. Then I think the three C's played out from the end of Jan. The implications in terms of how the market action was supposed to be construed got played out, because I think the markets then started sensing that this is far more virtual in terms of economic and financial data that getting played out, and the knee-jerk reaction that you probably saw in the markets. So I think unlike earlier crisis, 2004, 2008, what you probably also saw in terms of how the earlier moves had been, I think the moves were stark. We also saw stark moves this time around as well. But largely, again, I think the kind of selling and the fathom in which the selling took place and the number of days it took for the market to correct 35, 40 odd percent from its all-time highs was mind-boggling. Investors probably were still grappling on what to do, and the markets probably did not give a chance. So I think the intraday low that the markets created of 7511 and the bounce back that it saw sharply after that, the moment that was a very volatile period where 4-5% was happening on a daily basis, either up or down, and the solid follow-through that we witnessed over the last few trading sessions have rekindled some kind of the hope in the market. So if you look in the chart itself on the left-hand side on the table that we put out, the Nifty over a year's period, and I'm taking March 31st as a reference point, has corrected more than 27 odd percent. The larger sell-off has obviously been seen in the mid cap and the small cap, which is seen at 36 and a 46 odd percent deterioration. Now, within the individual spaces and sectors itself, PSU banks have taken the worst hit on an annualized basis with a 60% hit. It's not that their balance sheets were in great shape. Yes, there were mergers announced in the hope of creating larger mega banks. In spite of that, and in spite of mouth-watering valuations, which have always been the case of PSU banks, the larger picture in terms of capital adequacy, in terms of asset quality pressures, in terms of sustainability in loan growth, and therefore the capturing of return ratios, along with the EPS and the RSI rating that our software throws up. I think all these parameters were still remaining on the softer side. Private banks, surprisingly, I think followed suit, because I think the three C's, as I mentioned, in credit risk averseness really haunted private banks as well. And again, I think the pressures playing out in terms of how advances growth will be, in terms of the lockdown, in terms of asset quality provisioning that will be required, in terms of unsecured advances. All these factors played out for the financials and even the private banking space as a whole. It's not that this space was cheap. So on a price to book, on a price to adjusted book parameter as well, these banks were trading above their historical standard deviation, above their historical means and medians. And I think the kind of reaction that these stocks received was also something which was there, along with markets moving lower at a very sharp pace. So I think there was a 41% deterioration on that front. It was aptly, again, I think with correlated with metals and autos, because what happened with the US-China trade war fears, some respite laid in terms of some phase one deals getting signed off at the end of last financial year. But largely, again, I think with demand and supply both playing in against the sector as a whole, whether base metals or otherwise, I think the metal sector continued to take a beating this year also. Slower demand, expectations of how demand will play out, expectations in terms of revival, the transitions from BS4 to BS6, liquidity issues in terms of dealer refinancing. All these factors played out negatively for the auto sector as a whole. And again, I think clearly the scrappage policy, where a lot of hope was laid out, not coming through. And still the expectations are that as it comes through, I think there is some hope in terms of some volume revival for the sector as a whole. I think the auto sector felt the big tide heat as well. I think pharma was also saw some element in terms of profit booking, in terms of how the sector was placed in terms of FDA concerns, in terms of pricing erosion that they were facing within the US markets itself. And that probably played out on earnings, and that clearly reflected in terms of that index also coming off. FMCG was the only index that probably survived. It was still down 10%, but I think regular consumable items, regular items still need to get consumed. And we've seen that in this lockdown phase as well. These stocks probably still stood the test of time, and that index corrected far lesser than the others at a 10% correction or degrowth compared to the others. IT had a mixed bag. A few of the large cap IT names held up during the year. A few of the mid cap IT names had a surprising stellar move during the year itself. But largely, again, I think I'll discuss in turns. I think IT sector might feel the effects in terms of a few sectors that they cater to actually facing the heat, and therefore I think execution and these issues playing out in few select mid-cap stocks, while large caps might still survive with reasonable order books at hand and the capability probably to service their clients from offsites, which probably are and which would probably be in an advantageous position compared to those. Realty had a horrendous show, which continued. In fact, it was the best performing sector the year before that. So I think the moves in terms of working from home, in terms of how the commercial real estate will play out, in terms of rebalancing of prices for key markets, key pockets, oversupply in terms of inventory levels, whether it's residential or the commercial market itself, and whether I think there is going to be some element in terms of earnings readjustment for the sector as a whole. I think that also needs to be observed in greater context in the year to come, and that index for the last financial year had a correction of more than 35%. Having said that, we will now move over to our PanRay graph. I think this is our institutional software, and what our institutional software PanRay is throwing out is very, very clear. So I think if you've got, and if you can see these four quadrants very, very clearly, the right hand quadrant is the outperforming and the improving quadrant, where the earnings are expected to improve, and where the entire focus in terms of an EPS rating, in terms of how their RSIs have held up, and how their overall portfolio in terms of products at hand, in terms of the return ratios, specifically ROEs, are shaping up, and the chart patterns have not got dysfunctional in a way. So again, I think healthcare, within healthcare itself, pharma specifically stands out, and that has been turned out to be a sector to be looked out for over the last couple of weeks. Within the consumer staples, as I said, I think when you talk about consumer discretionary or FMCG, I think beverages, dairy, confectionery, and FMCG, I think these products should hold out. A lot of FMCG within their sub-segment or within the sectoral exposures that they've got have reasonable exposure within dairy, confectionery as well, and a certain element in terms of beverages actually might also stand out in terms of sectors which can be outperforming and improving. This is obviously something which is laid out over the next 16 to 24 weeks. So over the next 16 to 24 weeks, I think these sectors should outperform, and that is where the earnings objective should also be. Earnings should also reasonably and steadily hold out for these sectors at play. In the left-hand quadrant, if you see very, very clearly, I think the underperforming and the weakening sectors include a whole host of sectors which are exposed quite significantly to the economy and to the consumer-facing sectors as well. In terms of not the daily consumable or discretionary needs that we've got, but some purchases which can also get deferred. So I think when you're talking about financials, when you're talking about consumer cyclicals, and there again, I think a lot of emphasis needs to get laid out because there are supply side issues as well, as I said, and some demand side issues as well, which will play out on earnings. Energy, obviously, I think is going to feel the heat in terms of how their balance sheets are going to get played out, how cash flows are going to get played out as well over the next few quarters. Transportation and basic materials as well. We've obviously seen, as I said, supply issues. So I think all these sectors, which include capital goods, which include utilities, which includes consumer cyclical, which includes to a certain extent financials, which to a large extent would also include microfinance companies, rural focused NBFCs, aviation stocks, hotel stocks, leisure stocks. They are going to feel the brunt in terms of earnings. Whether a package gets announced for these sectors, I think you might see some element in terms of a V-shaped recovery playing out. But ultimately, I think markets, as I said, respond to earnings. I think the short-term move might very well play out for these sectors, even if such packages are announced. But earnings is something that where the focus of the markets lay out. And if earnings turn out to be bad or turn out to be a little bit worse than what the markets are probably penciling in, these sectors will feel the brunt. Now we'll go forward for each sectoral performance for the year, and I'll quickly take you through how each sector is expected to perform for the given financial year as well. If you probably talk about IT, and we'll start off with Nifty IT itself. I think the Nifty IT had a very sideways move, if you see, for the better part of FY20. So I think it was not a great move that one really expected to be seen from Nifty IT. But again, I think in terms of what was getting played out, a lot of IT companies were proactively managing the digital ecosystem very, very well. They were getting onto the digital platforms. The percentage of digital contribution to their revenues had increased substantially over the past few years. Top tier IT companies obviously had very, very healthy order books. If I bifurcate within the kind of sub-segmental exposure that they've got, BFSI still accounts for anywhere between 30% for top tier IT companies. It is obviously followed by retail and manufacturing, because these are the sectors which contribute the most in terms of order flows for IT companies. In terms of geographical exposures as well, the US market presumably has been and will be the biggest market for IT companies, followed by the European markets, and then the emerging economies as well, including certain elements in terms of Japan and Australian markets also lending support. So I think if you lay out all this context as well, I think the IT index played out quite reasonably. With the market correction that it saw, with the brutal fall in the past few weeks, there has been a reasonable amount of pullback that the markets have seen. Again, individually stock-wise, if you look at the table downwards below the chart, the maximum hit that stocks have taken were the mid-cap stocks, as you see. Tata Elxsi, for example, took the maximum hit of 37%. It was followed by Wipro at 35% and HCL Tech at 35%, and Tech Mahindra as well in the similar range. So the expectations of Wipro in terms of earnings outlook, and again, I think it has largely been very, very range bound between 0 and 2%. In fact, it also went into negative terrain for a quarter within the last financial year. But I think the different sub-segments that Wipro serves, the kind of order book that it has got, and the market expectations, so I think valuations are mouth-watering for Wipro at this point of time. I think the EPS and the RSI rating for Wipro still remains extremely weak because they are not able to perform to the top notch as the other players are able to perform. For HCL Tech Mahindra, for example, I think the expectations in terms of currency growth, and they largely upped specifically HCL Tech in terms of their constant currency guidance, with both organic and inorganic expected to contribute very, very significantly for the company. I think a large element in the year to be seen is how order flows are going to emanate. Because if you're probably expected to see discretionary spending for all these developed markets actually being very, very cautious in the quarters to come. And historically also, I think the precedence that needs to be followed is whenever there is a presidential election in the US, discretionary spending comes off a tad bit. So I think if you combine these two factors together, there is every chance that discretionary spending might just come off a tad bit for these companies in general. There is a large scope in terms of how execution takes place, how they'll be effectively able to cater to segments like BFSI, as I said, retail, manufacturing, which will go through a small U-ish and and a shallowish kind of a curve when it starts coming into the upswing as well over the next couple of quarters. We'll clearly get a hit in terms of the earnings outlook. How their EBIT margins will play out are going to be extremely critical, because I think optimization might need to be done in terms of their SG expenses for IT companies as a whole, how they're able to manage their on-site, off-site labor, how they're able to manage their utilization levels as in general. Because when we're probably talking about utilization levels staying between 80-85%, that's one healthy parameter that one needs to account for when it comes to IT companies as well. Tech Mahindra, again, a case in point and an example again, I think how their corporate communications or the communications segment in general is expected to perform with the advent or the capex plans for 5G with the kind of hit that we've taken, which might get delayed substantially, enterprise might hold up for a certain element for Tech Mahindra, but the communication segment might just taper off, which basically means that the constant currency or the dollar revenue growth that you're talking about might actually come off. TCS, again, I think how their insurance vertical plays out, because as I said, I think insurance also becomes an important critical and element part. The Japanese market had started showing signs of revival, but if there is signs of stress happening on that market as well, you might see some element in terms of degrowth, along with how Europe and America, which account for almost 32%, uh, needs to be needs to be seen as well. So in that context, again, I think Infosys had a couple of positive elements coming through. I think the SEBI statement that came through, the expectations in terms of what the SEC might do in terms of the whistleblower complaints. I think that might tide over in terms of the overhang that the stock had. But a large element in terms of earnings and the element, as I said, in terms of the constant currency and the US revenue growth in dollar terms needs to be tapered off. So I think a lot of IT companies might actually have their earnings sheen being taken off. And this quarter's performance will be extremely critical. This quarter's performance will be a little bit soft. The EBIT margins might also come off for a lot of IT companies, whether it's large cap, mid caps. A lot of mid cap companies have got exposure towards the aviation sector globally as well. To name a few, I think NIT Tech, Hexaware, for example, travel, tourism as well. So as these sectors are feeling the heat at this point of time, and as they will take time to recover over a period of time, you're probably expected to see huge element in terms of order flows and the execution in terms of the deals that actually getting delayed for these mid-cap IT companies as well. And the kind of earnings trajectory that they were exhibiting in the previous quarters might actually start coming off. So I think IT companies management commentaries are going to be extremely critical. But this time around, I think even if you're seeing the tailwind in terms of the dollar depreciation that we've seen for the rupee, I think a large offset might actually happen because of these macro effects actually offsetting the tailwinds from the rupee depreciation that we'll probably see. So IT companies probably are going to see some element of hit being taken. But again, I think anybody holding on, as I said, to large cap IT companies are still better off. But I think management commentaries is something that will do the trick. But there are elements of pain that IT companies will witness in the year to come as well. We now move over to the next sector, Nifty Pharma. And this sector, as you're seeing in the chart itself, as I said, I think this sector felt the brunt, and the brunt was felt because of the FDA concerns that a lot of companies within this sector were facing. So FDA had a lot of issues related to a lot of plants and a lot of EOIs, BAIs were raised. So there were a lot of expression of interest, voluntary actions that were indicated. There were also some plant closures that were indicated. No ANDA is expected to get filed. A lot of compliance costs related to the same as well as the pricing erosion that these companies were facing within the US markets itself. So the pharma sector was clearly getting played out in a negative fashion because of all these factors, but it has also bounced back very, very sharply. I think the reason is very, very obvious, right? In terms of whether these pharma companies will be able to provide a vaccine. I think a lot of pharma companies are rushing into the race for providing vaccine. And again, I think when healthcare cares come to the fore, a lot of these companies within these sectors, whether it's related directly to the pandemic that we're seeing at this point of time or otherwise, I think it's a sort of a defensive sector that plays out very, very beautifully at this point of time. So again, I think with the strong follow-through day that we've witnessed over the past few days, we've become a little bit more constructive, and we have actually initiated positions in a few of the pharma stocks because here our belief is that the earnings hit, even if it is there compared to the other sectors as play, I think will not be that substantial. Yes, there were concerns raised in terms of supply issues. A lot of pharma companies were specifically API driven, are dependent upon the Chinese markets. The supplies in terms of inventories or the inventories that they probably carry were there till the March end quarter. A few companies also had a few more weeks of inventory left in terms of how inventory positions were getting played out. But I think a lot of Chinese companies have resumed, or the factories have started production, and the supply issues related to a lot of even these API manufacturers in the Indian context, they should get their stuff through. Yes, there have been concerns raised in terms of raw material prices moving higher for key APIs that need to get produced. For example, paracetamol, for example, which is a key ingredient for all the fever-related tablets that we take, or even to a certain extent erythromycin, which are related for bacteria-related infections. I think these API prices have shot through the roof. But again, I think the supply, if it comes through, and even if pharma companies might need to take a hit, if they're not able to completely just state both the API or the raw material increases for manufacturing of these key ingredients in terms of the overall finished dosages, and even the logistic issues in terms of getting these supplies on board and to their factories. So the ex-FOB prices that get paid out because of the transportation issues at hand, even in the Indian context, that is, hits the Indian ports here, and the expectation in terms of the supply-related issues, which a lot of FMCG players have also put out. I think that issues might still take a hit. Therefore, I think the earnings hit might still come through for these companies. The utilization levels, if not optimal, and if not entirely absorbing the fixed cost, will still get played out on margins. But again, I think the volume growth, because they have started utilizing their factories in full force. What you've also seen in terms of the US FDA, what Mr. Modi had done in terms of allowing the hydrochloroquine supplies to the US, Trump tweeting back in terms of what a great friend India is. I think all these aspects have actually led a positive connotation in terms of pharma companies and a lot of approvals coming through. So if you would have read over and read between the lines to the last couple of days, a lot of A&D approvals or FDA approvals are coming through for key approvals and key products for a lot of pharma companies. Whether that's Lupin, whether that's Granules. The biggest approval came through for Cipla in terms of Advair. So Albuterol, which is obviously the respiratory drug and the generic drug of Cipla, Advair, I think that's 120 million odd size that Cipla has. The expectation was that its approval will come in the second half or the later part of this financial year. With the positiveness that has been shown between the two economies at this point and the approval which came as a surprise, I think the earnings upgrade is going to be quite substantial. Just to context, I think Advair is 125 million odd drug. Lupin has a far larger drug within the same respiratory space at 600, 650 odd million. What my own perception is, with the maximum number of plants or the FDA approval plants being in India, China, and Southeast Asia, if Trump needs to get back at China, I think the approvals for Indian companies for drugs, as well as I think a lot of concerns in a systematic fashion for the FDA affected plants getting over, and China actually feeling the brunt for the pharma related issues might actually play out. And pharma companies might actually see a new lease of life with compliance related issues systematically tackled both from the company perspective and the FDA concerns perspective as well. And a lot of FDA approvals coming through both in terms of ANDAs, NDAs that they will sign, specialty pipeline drugs with a lot of companies also possess within respective subsegments, whether it's cardiovascular, whether it's CVS, whether you're talking about diabetic medicines, whether you're talking about oncological medicines or even dermatology, which includes skin infections, for example. I think all these sectors and the drug approvals thereof will give a huge lease of life in terms of the potential revenues that these companies can generate, which can be far faster through the one was penciling in a later recovery from an earnings perspective. So earnings will take a hit, as I mentioned, for the factors as I disclosed. But I think this sector also has the offsetting effect on a huge number of approvals coming through, FDA concerns being resolved, which means compliance issues and larger drugs being filed, and a greater pipeline being generated in terms of the revenue generation for pharma companies as a whole. So I think pharma will remain extremely constructive from the next few quarters perspective, and even from an annualized earnings perspective as well. As I said, Panzri, our institutional product, has thrown up pharma, and as has been seen from the data points over the last few days and weeks, pharma is one of the better performing and outperforming sectors in these markets. It's also a very defensive play, so I think this is one sector that one should keep an eye out for over the next few quarters. We now come to the auto sector as a whole. And as I said, I think the auto sector was going through a torrid time for the better part of FY20 as well. You've obviously seen post the ILFS issues, what happened, the dealer refinancing and what happens at the dealer end. The expectation in terms of getting easy financing from the NBFC universe was missing. What this led through was obviously credit crunch at the dealer end. When a credit crunch starts getting witnessed at the dealer end, there is obviously huge say that probably happens in terms of how their individual working capital needs play out as working capital constraints start becoming more and more constraintful at the dealer end or the dealer level itself. You're expected to see that element getting played out at the end level as well. The second level also was that demand itself was very, very weak for the sector as a whole. So if you talk about two-wheelers, if you talk about four-wheelers, if you talk about MHCV players or even farm equipment players to a large extent, I think all these players within these sectors itself were getting impacted because of slow demand, refinancing issues, and these multiple issues played in tandem in probably having volumes which were far lesser that got played out. To add fuel to fire, obviously, I think the transition that was mandated from BS4 to BS6 played out in terms of balance sheet dynamics. A lot of companies had to clear off their inventory in this quarter itself. So the kind of discounting that one sees, and one that really expects that once this phase comes through, I think a lot of discounting happens in terms of getting your models or getting your inventory cleared off. So I think the discounting was also getting played out, not just for the MHCV sector as well, but even for the PV players, two-wheelers as well. The new emission norms, which are expected to come through from October of this year, will also have an impact in terms of how the farm equipment players will play out. So tractor makers, for example, above 50 horsepower engines will get affected in terms of the new emission norms as well. But how these players effectively cope up, or even M&M, which is a market leader in terms of the farm equipment or the tractor segment itself, needs to be seen. So I think if I go back to the index for FY20, I think for a large part, I think it had a downward trajectory and the index traded below its 200 DMA. It staged a recovery. Obviously, I think the recovery was short-lived because post the announcement that the exchequer did for the corporate tax cuts, all sectors moved up. So I think the auto sector was no exception to this. But again, I think it traded with a support of 200 DMA. And I think that support broke out very, very badly. And it took out all its averages in the brutal fall that we've seen. Now, the way ahead, as I look at things, is demand still remains extremely patchy at this point of time. How the entire rural landscape plays out, because what you've probably seen in terms of lockdowns, in terms of the daily wages or the daily laborers actually having to take a huge hit because of the lockdown pressures as well. Yes, Manrega wages have been increased by the government, which is a very, very positive and a proactive step. But till what extent does that play out in terms of discretionary spending from the rural, the semi-rural areas, and even at the urban end? If this continues for a longer period of time, if there is any element in terms of payroll cuts, unfortunately, we have to witness that. I think all these discretionary spending towards high-ticket items actually gets rolled back or gets deferred, which might actually happen in the second half. So we're actually looking and facing at the first half, which might be very, very soft, which might be very, very tricky for a lot of these auto companies, two-wheelers, four-wheelers, because a lot of people across sub-segments will actually defer their purchases. And then if that actually starts playing out, I think the second half of the festive season is something where the auto companies might have some amount of scope. The second element is also with BS6 coming through, that it has been price increases because there have been model changes which has happened. Example again, I think for two-wheelers, your traditional carburetor system has got changed with the electric fuel injection system. In the middle part of FY20, you obviously had the ABS, CBS, which got introduced for two-wheelers, where there was a substantial rise of around 5,000 to 6,000 rupees. So for anybody even buying within that 40-50% odd range, and not taking into account Eicher Motors vehicles, which are on an average around a lakh to 1,20,000 for the base version, and the new models in the 650cc variants, including the Himalayan, are high and priced at a much higher range. So with that perspective, again, there are certain issues to be played out here. Farm equipment solution makers, tractors, for example, I think the average selling price, as I was hearing Escort's call in the last quarter, they're expecting that to still be around 5 lakh odd. How the volumes play out is going to be extremely critical. The Rabi season has been extremely fruitful. So the expectation in terms of the Doppler estimates on how the monsoon will play out, the initial first signs are looking very, very positive, which means that if Manrega is the subsidy payouts, the direct benefit transfers that happen, if all this plays out very, very effectively for the rural segment as a whole, which is a large part in terms of the consumer population as well, there will be some element of offtake, but there will be some cautiousness displayed here as well. So the CAGR growth in terms of how tractor growth has been from CY15 to CY19 was quite substantial. How this plays out in the first few months is going to be tricky. So I think the first half, as I said, is going to be extremely tricky for all these auto players. It's going to be very, very soft. If any package, again, I'm saying, is announced for these sectors, there might be some spurt. You've already witnessed some element in terms of buying that has happened. Some shots getting covered for all these sectors which are highly correlated with the economic development economy as well. So again, I think that needs to be watched out for. But earnings, in my opinion, will be extremely soft, which means that you still need to be very, very cautious in this sector and take a very, very stock-specific approach. The auto ancillary industry, which is also related to the auto industry, gets affected. Obviously, I think the offsetting element in terms of tires, for example, or even consolidated players like a Minda Industries, for example, which is also into electrical components and electrical parts. I think the aftermarket probably holds out. The Chinese imports in terms of tires have been quite substantial. MHCV tires has already been an anti-dumping duty which is announced. But I think 20-25% in terms of Chinese tire imports will actually come off. So I think to a certain extent, rubber prices coming off, RSS4, rubber prices have actually come off, though they've seen some element of increase in the previous few weeks. I think that still lends some element of support in terms of input costs going down and some element of support to the EBITDA margins of tires or auto ancillary makers as a whole. Generally, I think the auto ancillary players, the aftermarket should hold up, but the OEM or the original equipment manufacturers, players like Tata Motors, Maruti, Hyundai, Honda, for example, I think with their volumes itself remaining very, very patchy and offtake remaining patchy, I think there is some element in terms of price erosion on the OEM part. So the aftermarkets might hold up, but that will not reflect in terms of a huge operating leverage being played out because of the OEM softness that you'll witness. So tire players, battery players, for example, even if lead prices have come up, and again in the last few weeks, they've seen some element of spike. I think the hit that they will take or might take in terms of the e-batteries that will come out or the investments that a lot of these companies are doing towards electrical mobility might actually have a huge hit for these battery makers as well. So yes, to a certain extent, again, the aftermarket in terms of how these battery players will play out might offset the impact from the OEMs. There is also element of resemblance of industrial applications that they've got, and with industrial activity also coming off, when you talk about UPS players, the telecom players that these players service are clearly going to be under pressure. Bearing players, again, I think had a typically mixed quarter and a very, very soft quarter even in the quarter gone by. The OEM remains soft for these players as well. Industrials might actually hold up. The aftermarket might hold up for these players. But with lockdown pressures being seen, I think the first quarter might be soft. Again, I think bearing makers, aftermarket might still hold up. But the original equipment players and the industrial activity actually slowing down offsets the kind of gains that you probably expected to see. So I think the entire leverage that one was expected to witness for a few of these auto ancillary players, that entire operating leverage might still not play out. So as a sector, I think one needs to be a little bit careful, a little bit cautious. Yes, there will be time when you will probably get better opportunities to enter. Is there a feeling of mixed out for the market and certain sectors as a whole? Absolutely, there is. With the market move that we've seen and further market move that can still come through, there is obviously that feeling that comes through. But earnings are still expected to remain soft. The EPS rating, RSI ratings are still not great. So even if you look at a lot of charts through our products in MarketSmith India, AlgoSmith, I think the charts are still not coming off a proper base formation. They still are trading way below their moving averages. And again, I think a proper base formation is required before you enter or into these charts, because I think there is every element. If earnings disappoint, I think all these parameters might actually turn out to be sour. and they actually might reverse. So I think you need to be really cautious and be very stock selective when it comes to the auto or the automotive space. Metals, I think, has felt the pain even in the year before this. When you talk about base metals, or when you talk about the ferrous metals as well, so I think steel players or the others have felt the heat. A large element of the heat was felt because of the US-China trade war pressures. Obviously, the supply constraint and the demand coming off globally as well got played out in terms of LME prices. And the realizations, therefore, are still expected to remain extremely soft. So if you talk about nickel being the only exception, which was in the last financial year because of supply-related issues, lower supply expected to hold out prices, and that is the entire reason why nickel held out. But even nickel has come off substantially from its all-time high levels. And large expectations in terms of this commodity universe. And commodity basically needs to be played out in cycles. So you need to be timing your cycle exactly well. So I think when you're talking about a super cycle playing out, has that super cycle started playing out in terms of commodity stocks in general? My own sense is no. I think flat and long products, as we look at things, both auto demand and the other demand on which a lot of these commodities are based out, I think remains extremely soft and patchy. And therefore, I think the kind of demand outlook that one has, both globally as well as on the local scale, still remains extremely soft. The second element in terms of input costs for these metal companies, both ferrous as well as non-ferrous, when you talk about iron ore prices, coking coal prices, they had come off, but with supply constraints coming through, both for iron ore, coking coal, for example, and iron ore with the 62% iron content, which is supposed to be the best iron ore globally, I think those prices have started inching higher. So what this basically does is with flat and long products, both expected to be on the softer side, Chinese HRC, Chinese CRC, which is the hot rolled coil prices, and the cold rolled coil prices have come off significantly from their year highs, though they've seen some respite from their bottoms. Still, I think the softness in terms of exhibition of these prices, along with volumes expected to be soft, a lot of miners globally, if you see a lot of balance sheets, if you read a lot of transcripts of Rio Tinto, BHP, they are still very cautious in terms of how the year is expected to play out. In this scenario itself, I think volumes are expected to remain soft. The ancillary prices in terms of scrap steel, scrap iron, ferrochrome prices behave a little bit abnormally at this point of time, but they're obviously dependent in terms of how the core base or non-base or even the ferrous prices are playing out. So even your graphite electrode players, for example, will largely depend on this pricing, with pricing really not being there, with volumes expected to remain soft, and with input costs inching up a tad bit on the higher side, with inventory built up seen across ports. There is every element that these stocks might actually feel the brunt in terms of cash flows. Leverage companies, where a large element of these companies are highly levered, also play out negatively in terms of balance sheets. So that also gets out negatively in terms of our EPS rating. So if you go into our product, if you are not registered, I'll say get registered, enroll yourself, become a member. I think the EPS rating turns out to be very soft because of these factors. The ROE obviously doesn't play out. The ROCEs, or the return on capital employed, becomes very soft. The capex plans get deferred because obviously I think companies need to be very conscious in terms of how do they play their balance sheets. So the capex plans get laid off, the new capacity expansions get laid off, utilization levels in their existing plants obviously do not work at optimal capacity, which means that the fixed cost absorption does not happen, and the operating leverage that one really needs to see from price volume action actually gets played out in terms of a negative fashion. So I think the negative operating leverage actually gets played out on their balance sheets, which reflects in cash flows being very soft as well. So for the counters as well, I think it's going to be a very soft year. It's going to be a very slow and gradual recovery. Domestically, I think a few companies might still hold out because domestic volumes might still turn out to be better than local volumes. But ultimately, I think we are dependent in terms of LME realizations. And if LME realizations are soft, even if rupee depreciates against the dollar, I think the offsetting effect is not substantial for a top line growth, which creeps through and elevates all the way down to the bottom line. So are there trading moves possible? Are there momentum moves possible? Absolutely yes. So you need to follow through in terms of how our swing trading act or how our swing trading recommendations will play out. There is every possibility that swing trader one of our other products, which also has done phenomenally well in the given financial year, might throw out some opportunities for year. But from an investment perspective, I think there's still time for the sector as a whole, whether it's ferrous or non-ferrous. Expectations largely metal prices expected, specifically steel prices, between the 400 to 450 odd dollar range. Zinc is expected to be around 1500 to 1800, along with aluminium expected to be in that same range. And the expectations of nickel actually being around 11,000 odd, expected to hold up for the better part, which is still substantially lower than what we've seen for the past year. Swing trader might have, as I said, in terms of the momentum pressures or calls over the next few days or weeks. But from an investment perspective, I think the EPS rating, RSI rating still looks extremely soft, unless I think there is substantial move, unless there is some elements of EPS upgrades that happen through our proprietary software, ratings going higher, and averages being taken, as I'm seeing in the chart right now, and as you're witnessing as well. If with volumes the 50 DMA is taken out, I think there might be some case in terms of an investment argument that can come through for this sector. Now banks, and typically I think this is one of the better rated sectors. This is one of the sectors which had given a better return over the past few quarters, past few years as well. And this is one sector which surprisingly held out in a substantial fashion over the last few quarters. Now it has traded from a chartical perspective above its 200 DMA for the better part of last year. It made a new all-time high, surprisingly, on December 30th of last year of 32,613. But after making that high, it turned sideways, and then obviously I think it fell and it succumbed to the global pressures and the global pandemic that ensued after that. So I think this bank index that I'm talking about has a mixture of both public and the private. I've also got a different couple of slides differentiating between the private and the public counterparts as well. But for the bank index as a whole, as we see it at this point of time, all the stocks within this index got hit big time. So I think there were a few reasons on why the street is being very, very skeptical as the way it is for these stocks in general. What you've probably seen in terms of the credit risk averseness, what you saw in terms of the fallout of the PMC Bank fiasco, what followed after that in terms of the Yes Bank fiasco, and how State Bank and the other banks had to come out as white knights and probably infuse capital into the bank itself and create some sort of confidence from a deposit perspective as well as bondholder perspective. So I think ATF1 were practically written off. I think to safeguard deposit interest was the prime focus of both the government and the regulator as well. So capital infusion has come at a cost, because I think the credit risk averse that has paid out for the system as a whole has been pretty stark as well. The non-food credit growth, even before the entire pandemic started off, was very, very soft at 7.98%. The expectations largely is that if loan growth tapers off because of the lockdown that we've seen, and as the loan growth takes its own time and its own feet to find in terms of how they will come back to normalized levels, it's still going to take a substantial quarter or two. The second element is to what segments have these banks basically lent to. So I think a lot of public sector banks have lent to a lot of MSMEs, SMEs, which are the sectors which are going to feel the brunt in this fall itself. And then in this kind of an economic situation as well. So in the classical case of advances degrowing, and if certain sectors like this regrow even further, the hit that they take in terms of advances growth in a scenario that non-food credit was actually languishing at % comes off, you go to substantial advances degrowth happening for a lot of these companies. The second element obviously is apart from these key stressed out sectors as well, the retail sector, which was obviously getting lent the most by even the largest of the best of the private counterparts, a lot of these retail lending was actually happening on the unsecured part. So the unsecured element is nothing but personal loans getting lent out. What happens in terms of credit card loans that were getting disbursed. So what happens for all these elements in general, and whether there are any delinquencies or asset quality pressures that can get witnessed, as I said, because if a large part in terms of the unorganized sector feels the hit in terms of people not coming through, not getting employed, if there are a possibility I'm keeping my fingers crossed. If there are any wage cuts that happen for organized sectors as well, I think how they'll be able to service these elements is something to be seen. We've obviously got a large part of the urban population that already has a lot of mortgage payments to be done, which is a house loan repayments as well. So I think a lot of NBFCs which are catering or catering to this element as well. I think how many of these loans actually get categorized as Cat 3 and how much of that actually comes on to their balance sheet in terms of pain, either through Cat 2 or Cat 3 disbursements. What happens to a lot of exposures, as I said, for a lot of these companies when it comes to the SMA 1 or the SMA 2 accounts on the corporate SME, MSME exposures, and how much provisioning might be required for all these elements if this pain persists, is something which is plaguing the street in terms of an earnings perspective. So if you look at all the context together, slowing loan growth, expectations of delinquencies increasing, expectations of provisioning going higher than the expected rate, PCR ratios even for the existing stressed out sectors and stressed out companies which have come to the fore, increasing at a faster pace over the next couple of quarters, and that taking a hit in terms of NIMs and spreads. Because what you've probably seen in terms of MCLR readjustments on bank balance sheets has been clearly that if advances rates start coming off, you've obviously seen the pull through happening for SBI, for example. I think an obvious reaction is to recalibrate or readjust your deposit rates to a similar quantum so that your NIMs and spread gets readjusted to a large extent. What happens on the return ratios is an obvious reaction, because I think if all these elements play out, I think the return on assets and return on equity both soften out. For public sector counterparts, as I mentioned in the opening collage, there have been a lot of merger announcements that have been seen. What has been seen in the past with SBI's merger with other banks is that these mergers actually take the sheen off in terms of advances growth. Capital growth takes a hit. Capital adequacy has been very, very poor for a lot of these companies. What they also need in terms of creating additional buffers from provisioning and the lower tier 1 ratios in terms of balance sheet expansion from an advances side and being very, very competitive with their private counterparts is going to be extremely challenging. So though price to book, price to adjusted book might look very, very attractive and mouth-watering for a lot of these PSU stocks, I think the private counterparts might still have their strategies in place. But I think a lot of elements are getting played out. Have valuations come off substantially for a lot of these stocks? Absolutely, they have. Whether it's the right time to enter, my own sense is that you should wait out for the quarter's numbers. As I've said, with the correction that we've seen, with all these concerns which have got played out, I think the concerns appear to be valid, at least at this point of time. So even if there is a FOMO feeling, as I've been mentioning time and again, a feeling of missed out, and even if we miss out the initial leg of the rally, I think there is always sense and always logic and common sense to enter when there is substantial evidence to show that the banks might start exhibiting better performances going forward. So I think these quarters numbers are going to be extremely critical, but watch out specifically for management commentary where valuations have come out for a large part of these private sector banks. The second element before I move on to the FMC universe is the NBFC space as well. And though NBFC is not mentioned as a particular index, I think NBFCs were classically getting the problems in terms of getting refinanced from the banks itself. The bond markets, again, I think the refinancing from these markets were getting to be a very difficult source. The commercial paper market after the fiasco of ILFS, I think people had a lot of NBFCs had started de-risking themselves from getting away from commercial paper. A lot of NCDs were probably getting raised, though at a little bit of a higher rate of interest at hindsight at this point of time. But at least I think NCDs were getting raised in terms of buffering up their capital reserves so that they could lend and support balance sheet expansion as was seen in the past. Now, again, I think the exposures that a lot of these NBFCs have, and I'm not talking about the rural focused one, the other urban focused NBFCs towards MSEs, SMEs, MSMEs. I think a lot of these sectors might feel the stress and the pinch. What might actually come through, as I said, which holds for the banking sector as a whole, and the inability for these stocks, leaving apart a few of the better rated NBFCs like Bajaj Finance, Bajaj Finserv, for example, will find it very, very difficult to access the bond markets, because if you probably see, I think that AAA rated players can still get or raise money from the bond markets at a very, very good rate. I think any player which is below AAA, even an A, AA or a BB, I think these players are going to find it extremely difficult to raise money from the bond markets. How they'll get the refinancing rates done from the banks itself, or even for the housing finance companies from the NHB, I think it's going to be very, very selective. And again, in a slowing scenario where I think loan growth slows off, where delinquencies might move higher from the concerns raised, and where I think the cost of funds, which becomes an integral and important part for these NBFCs, starts moving higher without the ability to pass it through in terms of increases in terms of lending rates for the end user. I think the NIMs and spreads are also going to get compressed quite substantially. So I think it's a double whammy that you're probably seeing. The moratorium that has got announced in terms of waivers by RBI for the first quarter of the 3 months that ensue are also going to take a hit in terms of bond holders, because that moratorium has not got extended for NBFCs. So I think the asset liability management that they need to do, the cash flow management they need to do from an ALM perspective for this quarter also will be under the scanner. So I think NBFCs, rural focused NBFCs, where typically I think the pain will be far larger for all the factors mentioned. And if there are any signs of delinquencies coming through, I think there will be huge amount of earnings hit that these companies will take. So extremely cautious on NBFCs as a space. Valuations for private players attractive, but watch out for commentaries. Public sector, very, very attractive valuation. But again, as I've said, historically as well, even on their median averages, I think you probably need to still wait out till either the private or the private public players individually show individual signs of EPS rating upgrades and RSI upgrades with averages taken out over the next few weeks. We now move to the FMCG sector, the consumer discretionary space. Now this space surprisingly had come out into the limelight. It recovered in the H2 in the second half of the last financial year. It retook its 200 DMA, but it remained choppy ever since. The FMCG also has reacted very, very negatively, but it has bounced back very, very sharply as well. Because what has happened over the last few weeks, I think people have realized that in terms of normal consumption activities that you probably do, the element in terms of the daily things that will still get required. Pulses, you need your vegetables, fruits to be consumed, washing powders, toothpastes. I think all these consumption items are still required to be consumed on a daily basis. So I think the fast-moving consumer goods, a few of the discretionary, a few of the staples might actually turn out to be something which can have a reasonable amount of earnings growth. Yes, hit can still take place. As I mentioned, for the pharma sector as a whole, for the FMCG players, and when I was looking and listening to a lot of managements at play, their factories are still working at around 40-odd%. Supply constraints are still there from a transportation perspective, but largely, again, I think they're still utilizing their you've probably seen that at this point of time, a lot of companies might still have a lesser earnings degrowth compared to the others. I think a lot of these companies, if you probably look at the FMCG players in particular, the volume growth should be still reasonably flavored out for this quarter. Again, I think with capacity utilizations happening across their factories, improving by every passing day, I think the expectations of volume growth actually holding up, though I think coming off on a year-on-year comparative basis might still turn out to be true. Pricing has still held up for these players. So I think the volume-led pricing growth, which is necessary to create a huge operating leverage from a balance sheet perspective, might still turn out to be very, very good. And therefore, I think stocks like an HUL, for example, have still turned out to be market winners, even in falls like this. It has got aptly supported by stocks like Nestle, because Nestle is a pure urban consumption story. So if you look at Nestle, I think 80% of its sales comes in from urban areas. Urban spending and discretionary spending has still held up. What you've probably seen in terms of their biggest products, whether it's confectionery, packaged foods, or ready-to-eat foods, including Maggi, has still remained. Maggi has surprisingly been off the shelves. I think even the local kirana walas are now saying that you can only take one Maggi at this point of time. But I think that should hold out. So I think a few of these players have shown huge resilience. Colgate Palmolive, I think, as I said, the toothpaste growth, or the naturals portfolio that it has got. Dabur, with its diversified portfolio that it has got, in terms of digestive supplements, in terms of hair oils, in terms of juices. I think all these factors will still play out very, very positively. Britannia has got its biscuit portfolio. To a certain extent, beverage players, I think there have been certain news that have been hearing. Very few states might actually have liquor shops that might get opened up. Tata Consumer, where I think a lot of consumer spices, pulses, salt still gets sold out. It's stores through Star Bazaar, where a lot of his stuff gets sold off. Star markets are still open. The activities have still not shut down over there. Yes, as I said, supply issues related to transport in terms of packaging still remain very, very evident. But again, I think the earnings degrowth not to start. So as I said, I think pharma, selectively consumers is where we remain constructive about because the earnings hit A will not be that evident compared to the others. And the second element in terms of both their EPS, their RSI rating as shown in our charts and as exhibited by our charts through our products and markets with India seem to be on a very, very strong footing. So this is one sector along with pharma that I will keep my eye watch out for. Real estate. Now, this sector obviously was a better performing one, but what happened last year again? The year before that, I think it turned out to be a surprising winner. Last year, obviously, I think the sector felt huge pain. The pain is felt across sectors which are residential or commercial itself. Again, I think the index stage a reversal from the starting of February, but it has again declined substantially along with the market move. If you typically divide the real estate sector itself, I think the real estate sector, if you divide it in 4 zones, north, east, west, and south, in the south zone as well, are very, very clearly indicating that the pain in terms of inventory buildup has been quite substantial. They need to liquidate this inventory, whether they liquidate at a discounted level, and then also ensure that the sales velocity in terms of new launches or the new launches that they do hold out pretty well. Needs to be looked out. But with this contagion playing out, with all these factors playing out, I think the demand recovery in terms of real estate, specifically from residential side, might be very, very muted. The offset effect also might happen on the commercial side of things. So the commercial or the annuity part of their business, as we call it, might also start taking hit. Yes, I think all the annuity players who have renewed their contracts or their contracts exist for a certain period of time, they are safeguarded because of their contractual obligations, but to a certain extent, any new developments that take place, and if there is any element in terms of cautiousness or any rent renegotiations that keep on taking place, I think the annuity expectations that one has from commercial players also probably needs to be looked into context. Now, South India is typically a space which needs to be looked at a different angle. So I think South Indian realty markets have always been compared to how the IT sector has performed. So the information technology sector, which obviously has its footings laid out through hubs in Karnataka, in Bangalore, in Hyderabad. All these sectors probably play out very, very positively, with the sector throwing out positive connotations in terms of volume growth, in terms of constant currency growth, in terms of new trainees being hired, in terms of utilization levels, including trainees holding up. I think the prices hold out accordingly in terms of how the IT sector performs. Surprisingly, I think players like Sobha, Brigade, Prestige, for example, have held out, though I think the market correction has been pretty brutal for these players as well, because they were the better performing stocks as well. But again, I think the management commentary is, and individually, I think all these stocks are in niche segment itself. So Brigade has a mix of residential, it has a mix of affordable housing and annuity properties as well. Prestige has more commercial at this point of time. Sobha, again, a mix of residential and commercial. So how the rates play out in terms of end user property rates, how the commercial rates play out. These players obviously have huge land banks at their disposals, and land banks has a substantial lower acquired cost of acquisition. So I think the cost of construction, even if one adds to the cost of acquisition to the land bank, I think it should substantially still take care of the overall operating dynamics in terms of sales volume holding up. The key question mark is how will key sales volume actually hold up? And the better rated corporates, even to a certain extent, Godrej Properties, which had a lesser leverage balance sheet, 0.4, 0.5 times in terms of debt equity, have an asset light model in terms of not owning land, but doing it with terms of development with the others. And even that stock has taken a huge beating. So again, I think real estate, because of all these pressures and pressure points, might still turn out to be something which might feel the brunt. The better rated players, as I said, one needs to keep a watch for that. But whether time has come to buy, my own sense is that the RSI rating, the EPS rating for a few of these players within the sector also look very, very weak. I think the dynamic place sector, real estate, still looks very, very patchy from an earnings perspective. I think the key upgrades might happen as the second half starts coming through, the first half probably might turn out to be a huge washout, because the other factor that also plays out front for this sector is the monsoon season. As the monsoon season plays out, construction activities actually start coming off. As construction activities start coming off, I think the expectations in terms of either new sales launches and the expectations in terms of sales velocity both come off significantly. So I think both these factors will play out negatively for the real estate sector, at least for the first half of this fiscal. Now I've got a couple of sectors. We've already discussed that. We probably have missed out, as I see on these slides, the Nifty infrastructure sector. Now the Nifty infrastructure sector is one sector which obviously will react in terms of how the economy will play out, how the Indian GDP will move, and the parameter for that, or the biggest parameter for that, is obviously Larsen & Toubro. Now L&T has a huge order book. There are other players within the space itself. There are road developers. There are obviously, I think, a lot of EPC developers as well. So all these players probably feel the pinch in terms of how the entire sector will perform. Now, the order books are quite substantial for a lot of these sectors, but execution and how they are able to execute will be extremely critical, with a lot of contractual labor actually moving inside, right? A lot of migrant workers have actually moved back. When does this lockdown end? When do we actually start construction activities? Again, infrastructure construction, whether it's road, bridges, whether you're talking about heavy engineering products, hydrocarbon products, with the onset of monsoons, they also start taking a back seat. So I think typically, even if we assume lockdown pressures easing off by the end of this month or the beginning of next, you're typically staring at projects which might actually get delayed. With the delayed execution that takes place, I think the working capital constraints go significantly higher. If the projects do not get executed, I think the receivable days starts getting elongated, which means the working capital cycle starts getting higher. So that context itself will have a huge say in terms of cash flow from operations and cash flow yields in general. So I think the better rated corporates like an L&T might still hold out because of its balance sheet strength, because of less leverage on its balance sheet. But a lot of companies which actually have working capital constraints, which have got a lot of leverage on their balance sheets, whether they are road development companies, EPC players, uh, uh, power development companies from the EPC side. I think a lot of these companies might actually feel the heat and the brunt because of these factors playing out, and therefore I think there might be a sharp deterioration from an earnings perspective, which are actually played out on prices. A couple of further sectors which are facing the heat before I turn onto the last two slides is the sectors which are facing the heat the most. So aviation, hotels, and the aviation stock, aviation, hotels, and the film exhibition stocks. So when you talk about the aviation stocks in general, apart from the tweets that they were doing, which were hilarious, and you should actually go through the tweet thread that Indigo, Vistara, and AirAsia had. I think it was extremely humorous and hilarious. So apart from this element, I think the core business impact are going to be felt very, very badly. I think the prime quarter that this segment was expected to perform has gone under lockdown. There is a lot of element in terms of operating leases being played out, right? So I think the leases that they do, the rupee depreciation, I think has a huge obligation in terms of their payments that still need to be done. The parking charges that need to be played out in terms of parking that they do in terms of various airports that they've done, and any waivers thereof, we've still not seen that. It takes a huge hit. So I think there is zero revenue that is coming through. The competition intensity will still ensure that yields became soft, even if the long-run pressures are eased. I think the expectations in terms of how the entire process will flow through is going to be extremely patchy. The data that I was reading for US, and US is one of the most is one of the countries where I think the flying in terms of frequent flying from an aviation perspective is the most, that has come off significantly. So you can actually see the pain that this sector might take. Though ATF prices or crude prices as we see it have come off significantly, I think the expectations in terms of all these factors playing out negatively has actually been seen in terms of all these stocks reacting negatively, whether it's an Indigo or a SpiceJet among the listed players at this point of time. For the hotels, I think the average room rates for the better part of last year were close to 6,000 rupees. The revenue per passenger, per passenger was around 4,000 rupees. So RevPAR and average room rates are expected to come off significantly for this quarter. Like the aviation stocks, a few of the locally transportable domestic players might still have a say, but I think the hotel stocks might still have a huge amount of underperformance. The utilization levels had inched up quite significantly around 65, 66 for a few of the hotels. In case it had gone above 75 odd percent. So to that extent, again, you're probably expecting to see some sheen being taken off. Now, if ARRs start coming off, I said, and the large expectation is from 6,000 around 4,000 from an ARR perspective, from a RevPAR perspective, from 4,000 around 2.5 to 3,000 odd rupees as a base case scenario. You can imagine that if the utilization levels come down to around 60 or 55 odd percent, you're going to typically see a scenario which happened between 14 and 18, where a large element of hotel stocks classically got butchered because of lower utilization levels, ARRs getting played out in terms of balance sheet dynamics. So I think this is certain elements that a lot of these hotel stocks will play, whether it's Indian Hotels, EIH, Taj GVK. I think these stocks are going to feel the pain in the first half. When you probably talk about film exhibition stocks, with zero income coming through, and though I think the contractual obligations in terms of the employees that they've got is a short-term play, I think what happens in terms of the three business segments, I think the exhibition segment itself with zero revenues coming from ticket prices, food and beverages, which also has a huge amount of gross margins and which account for 20-25 odd percent. And the third element obviously is the advertising revenue. I think all these three elements take a huge hit. The rentals still need to get paid off. So I think what happens in terms of the rental obligations, and if there are any waivers that get announced on that front, need to be seen and observed. So I think those elements are extremely critical from a balance sheet perspective. But players, including PVR, including Inox, have said that they are expected to take a huge hit. If these lockdown pressures continue, I think the unknown in terms of the earnings hit, and if Q1 is assumed to wash out, I think the annualized earnings take a huge hit. Deferment happens in terms of key movie releases, and content is extremely critical from a movie goer's perspective. How movie goers are expected to come through to theaters in terms of the confidence itself is going to be extremely critical. Therefore, I think even exhibition stocks might feel the brunt. So I think these three sectors is something that I felt I should talk and discuss, because these three sectors are going to feel the maximum hit, and that hit is going to be very, very obvious. How bad that hit is, I think we'll come to know in this quarter's numbers. Individually coming to the last three slides, I think the last two slides we've already discussed that. So the private banks also had a horrendous show. I think RBL Bank, for example, took the maximum hit. Again, I think asset quality pressures have not been improving for this bank. So if you see the last two quarters, the asset quality pressures have been worsening. GNP is at 3.3, net NP is around 1.5, 1.8. I think that bracket improving along on worsening on the quarter and band, along with the stressed out assets at around 1,518 odd crores. I think that does not lend confidence in terms of whether this will go the Yes Bank way. So I think investors are very, very, very watchful. For Bandhan, as I said, with the daily laborers, daily expectations of daily wagers actually taking a hit, the microfinance exposure that it has got, and a lot of these microfinance companies, how much of a delinquency hit does that take is something to be seen. With Gru's inclusion in Bandhan's balance sheet financials, we have obviously seen some sheen taken off in terms of margins and return ratios, but a large element in a lot of these south-based banks as well. I think the exposure towards MSMEs, SMEs, and any delinquencies that come through and higher provisioning that might get required is obviously taking a hit in terms of how the capital adequacy will play out, and whether that erodes their tier 1 capitals as well, which obviously takes their sheen off from their book and the price to book perspective and their adjusted book perspective as well. So I think numbers need to be monitored for these players, but these players in particular, as I discussed, might feel the heat compared to the others the more. Public sector, I think there is no two ways to talk about this, but again, I think these banks have felt the heat consistently over a period of time. How the numbers stack up, I think, is going to be critical. How they're able to bounce back is going to be extremely critical from a PSU perspective. So whether these banks have the strength to bounce back very, very sharply in terms of loan growth, whether delinquencies are not as stark as one really expects. But again, I think the exposures will mean that delinquencies will probably still play out quite substantially on their balance sheets and the mergers itself. So I think the mergers will also take some amount of sheen away in terms of how growth will probably take place. So yes, public sector is something as a space that we have avoided, that a lot of market participants as a consensus have avoided. I think this is one space that one still can come under the avoid category. This is the final slide. I think in spite of all the mayhem that we probably saw in the markets in the year gone by, we've picked up stocks with a market cap of 1,000 odd crores and with an average delivery volume of more than a crore on a daily basis, and stocks which have given a percentage return more than 25 odd percent. So in spite of all the carnage and the mayhem that you saw in the market, you've still seen a lot of these stocks give phenomenal returns. The best stock obviously was Adani Green, 206%. A lot of these stocks still continue doing well. For example, Abbott, which had given a 112% return. I see a lot of these discretionary names, Berger, Relaxo, Amber, HULs, which had a phenomenal year last year, which also did very well this year as well. And even of these gas distribution stocks. So oil and gas as a space, surprisingly, I think will still feel the brunt because with volatile prices, expectations of volume growth expected to come off. 60 gas distribution companies, for example, CNG stations down, expectations of industrial activity pulling the industrial PNG down is actually going to take a hit from this financial year's perspective. With oil prices remaining very, very volatile, I think how GRMs will play out for a lot of these OMC stocks is something to be seen. There is expectations that there will be a substantial hit because the cracks, specifically gasoline, naphtha, and gas cracks have actually come off quite substantially. The correlation in terms of crude to petchem products, to downstream products will also have a say in terms of downstream pricing as well. So I think oil and gas stocks will also feel a huge hit. You've also seen these stocks correct quite significantly, whether it's upstream like ONGC, Oil India, or even downstream, where valuations again have become very, very attractive. But the large unknown and uncertainty in terms of oil pricing and rupee dollar movement, which are two critical components in terms of earnings quality and earnings perspective, will still play out to be very, very drawn. I think with this perspective, I think we are largely done. We will take a few questions at this point of time. I'll just take a couple of a minute or two for the question queue to get assembled. I'll also request Rushit, my co-host, to join in so he can help me out so we can answer more questions in a limited period of time. So just a minute before I queue up in terms of what questions need to get answered, and Rushit and me will then start answering questions.
Sure, Mayuresh.
Yeah, so Rushit, you can start taking the first few questions. I'll join in.
So I think there is a couple of questions related to rotation graph. So Mayuresh had explained about the sectorial rotation graph over the last 26 weeks, that how sectoral played off. So there were a few questions regarding how to interpret that graph and what are the meaning of that outperforming and improving and all those 4 quadrants. So ideally the graph is divided into 4 quadrants. And so this is the representation over the last 26 weeks. So there are the 4 quadrants are, one is outperforming and improving. The sector that are outperforming and also showing some improvement. Say for example, pharma, that since last few weeks, they are outperforming the indexes and also improving. So you see week after week, the improvement is good. Like pharma stocks are gaining the momentum, they are gaining the strength. So that quadrant is outperforming and improving. The second is underperforming and improving. So there are a few sectors that might be underperforming the markets, but they are on the verge of improvement. So they are improving as far as the price momentum is concerned. The third quadrant is underperforming and weakening. So these are the sectors that are underperforming and they are also weakening. So they are going down. So say for example, the banks, so they are underperforming in the recent few weeks. Though this rotation graph gives you an idea of 26 weeks, but just to get a better explanation, I am trying to connect with recent weeks only, that banks are underperforming and they are also weakening. I think few of the banks have gone way below its key moving average. The last quadrant is outperforming and weakening. So these are the stocks where you can see the peaks are forming, or these are the sector where you can check that peaks are forming. That yeah, though they are outperforming, but they are weakening. So first, whenever the sector becomes weak, the leaders sustain the gains, but the weakest stock in the sector starts falling, and gradually the stronger stocks, the leaders start falling. So this is how this rotation graphs help you to get an idea that how the sectors are moving. So whenever the sector is out improving, so that is a very good point to look at that sector. And when you look at that sector, you can drill down to the leaders in that sector. And yeah, these are the leaders that are improving, and that is the reason why the sector as a whole is improving. And if those leaders match the canceling criteria, or you think that they are forming a base, they are in the right side of the base, they are soon to break out, then you can have them on your watch list. And whenever you get a right time, the market direction as well as the breakout is good, that's the time you can add the stock. So this is a very helpful graph as far as the research is concerned. Over to you, Mayuresh.
Yeah, thanks. So I think there have been a couple of questions in terms of the pharma and the FMCG sector. As I mentioned earlier, right? These sectors are the couple of sectors that are where the earnings degrowth might not be as substantial compared to the others. Yes, there might be a hit in Q1, but I think still the earnings perspective and the earnings trajectory might hold up. So I think there were a couple of questions. One, I think, what are we looking at from these sectors itself? So I think from the pharma space itself, we've got Cipla and Alchem Labs, which probably are looking better placed in terms of the CANSLIM or the O'Neill methodology. Cipla, obviously, as I said earlier, with the Advair approval that they've got, it's $120 million approval that they've got in terms of revenue potential. Expectation was the end of this financial year. Since it's come right now, and there is every expectation that even the European authorities might give a green signal, there is huge earning scope that will come through. There are a few risks that are still there. What happens to the Goa plant, warning letter, and so on and so forth. But I think the ANDAs and the return ratios are very, very sweetly placed. And as I said earlier as well, if Trump needs to retaliate against China and if the reciprocal action needs to be taken positively, I think some concerns with due actions taken on the regulatory end by the companies themselves. I think even the concerns related to FDA plants might get resolved along with larger approach on the NDA side. Same for Alchem. The US business has held up very strongly. Indian business is holding up strongly, and therefore I think the return ratios are very, very strong. So I think pharma as a space looks very attractive, even from a buy watch list perspective. As I said, I think there were multiple questions that were also asked for say stocks like a Biocon or Ipca Labs, for example. I think Ipca is a tremendous show. So with hydrochloroquine, I think getting approved and a lot of countries actually asking for that and we providing for the same. I think the concerns related to plants getting off for Ipca, specifically their import alerts on the Ratlam, Silvassa, these plants along with larger exports and the pricing remaining solid along with debt equity at 0.13 or 0.10 times, which is very, very negligible. I think it's very, very sweetly placed. So anybody holding on to Ipca should definitely hold on. Similar breadth, I think Biocon, I think the expectations of the biosimilars portfolio, the biologics portfolio, for example, I think expected to do extremely well with larger approvals coming through. The Malaysian plant has concerns with shutdowns and remedial costs coming substantially higher. I think it's still expected that that will get offsetted in terms of the biologicals and the branded formulation portfolio. So I think, yes, some stocks can be held, but certain stocks like a Cipla, Alchem actually fit our methodology. And certain FMCG stocks we mentioned in last week's webinar as well. I think stocks like an HUL, Dabur were there on our buy watch list. Yeah. So over to you, Rishi.
So there are a couple of questions regarding the group ranks. So basically this gives you an idea of the top performing group. So when you drill down from the sector point of view, then it comes to the specific industry group. Say for example, in financial services, that which are the groups that are performing well, that are the private banks, public PSUs, or the NBFCs or such. So this is how you can look at the group rank and see among the top. So in India, we have around 164 group ranks. Globally, we have 197 in O'Neill methodology. So out of that 164 group rank, we generally like the groups that are among the top 40. So these are the ones leading the market as of now. And you should always prefer something which is in the top 40. However, there are other things as well, the N factors or the earning factors, and a lot of things are there. But yes, on the ideal basis, a group rank among the top 40 is good. And someone has asked for a list of groups. So ideally, it is not available in the Marketsmith India's website. You cannot get a list of group ranks. but the stocks that you are shortlisting, so there are options in MSI website to shortlist the stock based on your EPS, RS, etc. So there you can have a filter of group rank also, and the stock that you like after your shortlist or your own criteria, and then you can check the group rank of those stocks and take a decision. So you cannot get a list of all the groups, but yes, you can, the stocks that you are interested in, or if you are reviewing your portfolio, then the stocks in your portfolio, you can just go to MSI, type that stock, and you can get the group rank of that particular group.
Thanks, Ruchit. So I think there are a couple of questions. Obviously, there was one question which was very specific in terms of IndusInd Bank. As I said, for the banking industry as a whole, right? I think all the features and the factors that get played out will get played out for IndusInd Bank as well. IndusInd Bank, in terms of its lending profile, has a couple of things that needs to get noted. One, I think their overall exposure in terms of vehicle financing. So vehicle financing or vehicle offtake itself has been very, very slow and very, very patchy, whether you talk about first-hand financing or even the second-hand financing. So there again, I think how the financing aspect plays out is going to be extremely critical. Second aspect for IndusInd Bank is also, I think, the dependence in terms of their wholesale loans. So wholesale loans are going to be extremely critically observed at this point of time, because these are the loans which can actually have a large amount of stress attached to that. Third, I think with the adjustments being taken for the sector as a whole, and the management change that has happened, how are they going to carry on their balance sheet expansion at the rate that they're doing at 25-30%? So I think a lot of questions are needed to be answered. As I said, I think for the industry as a whole, I think the correction has been pretty stark. So I think a proper base formation needs to take place. The EPS ratings and the RSI ratings have taken a huge hit. So one really needs to wait out for these quarters numbers, let a look at management commentaries, so on and so forth. Now there was one more question which has just popped up in terms of the specialty chemical player space as a whole. I think a few months back we had come out with a detailed report for specialty chemicals. Specialty chemical probably are again, I think reasonably and sweetly placed compared to the others, right? Because as a space, they provide inputs for a lot of end consumer industries, whether that's dyes, whether that's paints, whether that's pharma, so on and so forth. So I think which of these companies within the specialty chemical space is placed comfortably in terms of these niche products still holding out to their pricing power. Second, in terms of expectations of how the entire scenario will play out in terms of the volume offtake. So I think as capacities start moving up at their factory end, and as the volume offtake starts improving both locally as well as globally, because I think a lot of these export dependent specialty chemicals might still feel a hit in terms of Q1 because of logistic issues, trade boundaries being closed, so on and so forth. But how they are placed from a balance sheet perspective on a debt equity in terms of ROEs. In fact, I'd put out if you go to my Twitter handle, I think I'd put out a very smart table in terms of not just the specialty chemical players, but specialty chemicals, liquor, ethanol, and sugar players. And just a data reference point in terms of all these parameters, both from how they are placed on a 50 on a 200 DMR perspective, and how the ROEs, earnings growth has been, the dividend yield has been for all these players in the year gone by. So please have a look at that. So I think that will throw out a huge perspective for all these sectors in general. There was one question which I'll still take before I hand over to Ruchit. I think DMart. I think DMart is one stock that we like, but it's unfortunately, I think, on a 5% circuit. If you typically look at DMart's overall perspective, 52% comes in from the food segment, 30% from the apparel, and rest from the others. So with a lot of their stores not being in malls because they cater to a lot of the essential activities, the volume of take for DMart has been quite substantial. And that will itself lend a huge support in terms of earnings. One might very well argue valuations are on the higher side, but largely again, I think those factors need to be taken into account. We liked it. Unfortunately, I think it is locked on upper circuit at this point of time. For certain individuals who are not able to download our report that we recently come out with, my request is to just put in your mail ID so that the team can report back. Ruchit, you can take next.
I think most of the sectorial questions were there, and there were few related to our methodology, which we have already answered. So I think broadly all the questions from the sectors are covered, expect, I think aviation, maybe if you want to give a touch on aviation, then there are a few questions related to aviation. Otherwise, broadly, all the questions are covered from our point of view.
Great. Hey, so I think I also covered aviation. I think there were a couple of sectors which Mukunda and Amit M has pointed out about the telecom and the power sector. So I'll quickly take you through both these sectors as well. So for the telecom sector as a whole, I think FY20 was largely plagued out with the entire AGR related issues which dragged out a lot of these company balance sheet. You saw what has happened in terms of Vodafone Idea, in terms of the price performance itself. So from a telecom perspective, AGR dues was clearly something which plagued out. I think the subsequent Supreme Court order which came through and the self-assessment dues that all of these companies came out on their own, and the payment that they've probably done to the regulator and the government, I think the hit that they take in terms of cash flows is given and is substantial, and it's what the markets have recognized. Second is the tariff hikes that these markets have taken. And that these players have taken, and the tariff hikes that they have taken is in a very calibrated fashion, at least at this point of time. Now, if the companies need to negotiate both their cash flows and the impact that has to be seen in terms of the HRD readjustment, I think the improvement in terms of tariffs going on the higher side has to be taken into account. Because unless that happens, I think the kind of capex that is required, either for new auctions that will come through or the refarming of their existing airwaves, whether it's the 1800 or the 2200 or even the 2800, both in terms of 3G and 4G. And certain players like Vodafone Idea basically need to have a larger capex itself, because a large part of the subscriber base still is on 2G, which needs to get upgraded to 3G and their 4G. So I think this is the initial capex that is required. A lot of these companies have actually constrained their capex. So if you look at Bharti Airtel's balance sheet on a year-on-year basis, they actually had a capex of around 12 to 13,000 crores, which was around 26,000 crores the year before. So they've halved their capex. The auction prices that were laid out for 5G, I think that will definitely get delayed and deferred because the balance sheet strength is not there. So on a debt EBITDA level, Bharti Airtel, because of its robust operations here and African operations still holding up, I think still hold out. But Idea has still got a very weak dynamic. So I think if you look at the oligopolistic nature of the market at this point of time, and the data consumption that all of us are doing sitting at home, I think large element of that will still be that Bharti Airtel will still have better dynamics compared to the others. So I think Bharti might still hold out in terms of numbers compared to a Vodafone Idea. So that's for the telecom sector as a whole. The two sectors that I missed out was power and cement. Because there was some request on the cement sector as well. For power, specifically, I think if you're talking about the DISCOMs are in a bad shape even at this point of time. So if you look at the thermal power generation capacity of India, the expectations of solar or the renewable energy capacity is moving higher with the government objective over the next few years. I think the thermal players are still facing the heat on two counts. As I said, I think the DISCOMs or the distributors themselves are having huge receivables position themselves, and they are extremely debt laden. So the generators have two issues at play. I think if they keep on generating, they cannot in the first place, because the DISCOMs receivables are coming at a very, very slow pace, which means the receivable position at the generator end has shot up quite significantly. The second, apart from the IIP data where electricity growth was 8% for this for the preceding month, I think the general growth has been pretty patchy, and the demand growth itself, if it remains extremely patchy, and the offtake in terms of realization for renewables, because a lot of capacity was probably done for either wind or power as well as solar, but I think the realization growth in terms of the unit realization per kilowatt hour still remains extremely soft and patchy. So with that respect, I think the generators balance sheets also remain extremely soft. So for the entire power chain, I think it's a classical cyclical chain. I think till there is health improvement which happens from the DISCOM side, till there is substantial improvement which gets seen then from the generator perspective as well. And because I think a lot of the generators are highly leveraged onto their balance sheet, I think that creates an awful element in terms of cash flow mismatches which happen. So cash flow from operations, cash flow from financing and investment, I think all these three go for a toss. So there is basically cash flow issues at hand for all these players. So I think there will be issues for these players. The third element, the third sector properties, the cement sector as a whole. So if you look at the cement dynamics and the expectations of 60 to 70 MT of capacity getting added over the next few quarters, I think those, because of the conditions that we've seen right now, I think that clearly gets deferred. The second element is before the monsoon season starts, there is a lot of execution activity which takes place. But because of the unfortunate lockdown that we've seen, I think the execution activity has also taken a huge pause. So I think the inventory built up classically happens for a lot of the cement stocks, जहाँ पे cement का काफी offtake हो जाता है. But I think because of this lockdown and slowdown that we've seen and execution issues, I think even that will come off the radar. The second element is terms of cement prices itself. So like real estate, you have to divide it into four parts: north, east, west, and south. South is where classically there is a classical oversupply because of everybody competing to gain market share. A lot of infra projects have been announced, but again, pricing issues remain. North, I think the offtake in the west has been quite reasonable. So I think there were large hikes that took place on a reasonable scale. If I do a comparative base in terms of the large hikes on a year-on-year basis, but that again gets muted off because if the demand comes off and if plants are not able to utilize at full capacities, I think that again becomes a huge say. Obviously, the players out of east, and there are certain capacities being improved there with infrastructure development and roads and grinding and clinker capacities coming up in the east as well. I think how the transportation happens, because I think new accelerated norms have made it easier for larger carrying through happening with freight costs and fuel coming off. I think the freight power costs come off substantially, which means that if volumes are able to sustain and prices are able to sustain, the leverage gets played out because of input costs coming off, both in terms of coking coal and iron ore, along with power and freight. So EBITDA per ton improves. Unfortunately, I think how the volume and price dynamics will happen is something which needs to be seen. So I think cement sector, one needs to observe. I think the larger companies or the larger geographical area companies can something that can be there on your watch list as a base formation happens, and as the EPS and RSI rating comes and they come in their pivot range as per our products. I think that can be a sign where these markets can actually show a sign of strength. So I think these are the three sectors that I missed out. I covered that as well. Oil and gas I've already covered, so there were some questions on that. For the agricultural sector, Adarsha Esri had asked this question right now. So agriculture is pretty large. So I think if you probably talk about this sector, I briefly mentioned farm equipment players, which include tractors and equipment manufacturer, but there are also these input players, which include seeds, fertilizer players, and a few of these players who also come to the agro supply chain. So I think a few of these players might actually look good. Again, I think with gas prices coming off, right, and the gas prices have got revised to $2.5 per MMBTU, I think the input costs for a lot of these fertilizer players start improving and dynamically as well from an earnings perspective. However, I think, as I said, how the plant production starts happening, how the rural spending starts happening, because I think the Kharif season will be around the corner in the next few weeks. I think that is going to be extremely critical and fruitful. So I think these players can be watched out for. Seed players, again, I think what happens in terms of the BT cotton players, for example, need to be seen. Cotton yarn makers and textile makers, I think, are also classically feeling the heat, because if cotton prices have come up, the synthetic makers are actually feeling the heat because of inventory built up and demand actually coming off quite substantially. Last two questions that I'll take. One was obviously something to be done about the insurance sector. So for the insurance sector, I think it's wait and watch clearly. This is the key time in which a lot of people get insured. With the pandemic playing out, a lot of people that I speak to, I think, have opted for insurance. How the numbers come out in terms of the new insurance or the value of new business and the VNB margins, because they had clearly come off. A couple of managements, if you go through the transcripts, have pointed out that they do come off quite substantially. The third element is obviously in terms of the new tax norms that have got issued. So whether these income earners till that 7.5 or 10 lakh bracket, if they've got a better option in terms of spending more and saving the same, whether they will still opt for insurance policies is something to be watched out for. So I think one needs to watch out for that one. So I've discussed the theme. Tarun Big was asking about new themes. I think you need to play it, Tarun, very, very smartly from a sectoral perspective. As I said, Panry, our institutional product, and what is throws up. I think for the next few weeks, looking at earnings and the outperforming quadrant, pharma and FMCG probably look good. But as things start improving, the high beta correlation stocks also will start coming into play. So I'm looking at few more questions, but I think we'll take these questions offline. Try to answer most of your questions at this point of time. A few of the participants were asking me that I have been speaking continuously. Do I get exhausted, and what do I eat for breakfast? I think this is my passion. This is what I like. I can probably go on for 5-6 hours even without taking a pause. So that is how it is. But a large element is that observe how the data points are getting thrown out. Our products are brilliantly focused in terms of throwing that out for you. The second element is the presentation and the podcast itself, I think, or the webinar itself. The recording will be available over the next few days. And the third element, obviously, is be safe, be healthy. I think this is the right way to take our country to the next stage going forward. So I think everybody be safe, be healthy. It was a pleasure speaking to all of you. We'll speak to you again next Saturday with a new theme, which will be announced in the next few days. Thank you and take care.